Joining us today. We're going to be looking at the logistics markets and a really interesting deep dive down into the logistics markets in Europe. First of all, we'll have Tobias, and we'll be looking at, I guess, some of those kind of key elements in terms of the European side. And then we're also going to be looking at and drilling down into the Spanish markets. So really interesting session this morning. As ever, if you've got questions, please do ask them. On the right-hand side of the screen, you'll be able to see the comments, so please put questions in those. I'll be monitoring those, and of course, we're very happy to have your questions and answer them. That's one of the joys of being live. And if you're joining us on LinkedIn, you can also use the QR code, which is on the bottom of the screen at the moment, just to be able to also add your questions to the chat and make sure that we answer your views as well. So without more of ado, let me switch now over to Tobias. Welcome, Tobias. Thanks very much for joining us. Really interesting to get an update from you on, I guess, how you're seeing the European market, because obviously the Pyramid Research has been running for a period of time now. So it's great to be able to get that perspective also across those years. So Tobias, brief introductions from yourself, and then I'm very interested to see the latest research. Yes, why not? Why not?
Platform covering almost entire Europe. We started working in Romania from the beginning of this year, and we have not only development but investment, portfolio management, real estate management, and therefore it is so important for us to really know the markets, to be able to interact, to do business in those markets. And when we started 9 issues ago, 9 editions of the Pyramid Map ago, there weren't really good sources for really in-depth details of the most important KPIs, in this case, yield and rents. Therefore, this abbreviation pyramid and the iconographic display of the markets. Up to now, we cover 121 regions in over 25 countries, and we'll update this map every 6 months. And we started last edition with the forecast. We are covering or working together with Oxford Economics. So we're not only tracking how the market are looking like at the moment, but we are looking to the future, how they will develop. And we'll be happy to share with you the newest insights. If you want to sign up for our newsletter, don't be afraid. We don't really push much into this into your inbox. It's really about updates from the Pyramid Map or other exclusive insights into the real estate markets when it comes to logistics. Well, here in a nutshell, what we did find out in our newest edition of the Pyramid Map, we faced a long era of steep rent increases, especially after the start of the Ukraine war. We get to this later on. This steep increase has ended. And the last 6 months, we only see an increase of really not so much of 6 cents when it comes to the 121 regions, but we are stable in 69 markets. So this is really a stabilization of the rent development. It's not so much of a decrease, but we'll cover this later on. When it comes to yields, we saw really a slump in the investment volume of the last years. Coming from record-breaking volumes. And this came along with a really decompression in the last quarters, But what we faced is, what we saw, that we really had a situation in the market where is the different developments is coming to a halt when it comes to yields, and it's flattening out, and it's really a stabilization of this development. We even saw a few markets where a slight compression already started. So we are really starting, or rather on the brink of starting a new investment cycle. When it comes to the developments, it's important to realize that in the last phase of the market, we saw an alignment in developments, more or less, and this is changing. When the time moves on, the diverging market performance is really being visible right now. For example, you can see it in the UK or Netherlands when you are more or less in the more developed or older investment markets. And for example, we see a small cap rate compression in Benelux, Spain, or in high-yielding East European countries. Of course, we look into the future, and as you know, we have big geopolitical tensions. But if we look along those really present situation and look into what the dynamics of the economic development is looking like when it comes to the framework conditions of the markets, we see to the end of the forecast area an increase, for example, in rents, a moderate increase, and a moderate yield compression. So look into the details. What's new? What changed in the last 6 months? As you can see here, for the 5-year period we are covering in each edition, we saw an increase, like we said, really spiking at the very moment, as you can see. And this is, you can see for every kind of different markets, the big top markets we're seeing in Europe, but for the majority of the logistics regions as well. And even for minor or secondary markets, it's still a slightly lower level, but it's still, it can be seen that the big increase by €2.30 or 38%, for example, for the top market has come to a halt, as we saw in the conclusion. It's important to look into the market and see what is the pattern at the moment. As you can see, the 69 stable market are all across Europe, but you can see clusters of green small pyramids. For example, like I said, many markets in the Netherlands, West Brabant, for example, with the highest increase. Or in the United Kingdom, where we, like I said, we are already seeing dynamic in the rent developments, and even 25 markets at the moment are still facing a rental growth between or within the last 6 months. There are some markets, and it's more or less clustered to the, for example, Baltics or the Eastern European country when it comes to the Polish market, with some exceptions. This is because of, on the one hand, the vicinity to geopolitical tensions on the one hand, but for example, in Poland, when it comes to big pipeline completions, so there's really a big increase in available stock. And when it comes to Germany, there's a mixture between those markets who are facing really slowdown in take up and demand, or markets when it comes to too much stock entering the market through completions at the moment. What are the drivers behind this development in the last 5 years? As you can see, this is really an up and down of the. We use the PMI in the Eurozone for the economic development, industrial demand. Of course, you see a really big slump during the pandemic. It was really steep, but also short-lived. Then we have a record-breaking pace afterwards, and then a steep but slow demand. What did it change? What for an effect did we have on a vacancy? Up to 2022, not a real change, because, for example, e-commerce was still a very high demand driver. When for brief moments, the industry side was, for example, taking a slowdown. On the other hand, we had this big increase in demand from e-commerce and other drivers. So we had really an historical low in vacancy all across Europe, slightly above 2%. Then even afterwards, the investment volume faced a change in development. This was still ongoing, only beginning in 2022 that the vacancy, because of the still ongoing completion in Europe, changed the direction. So we are facing a few quarters now with an increase in vacancy, more or less about 6% now. And of course, what is the driver behind the big increase in rents? Of course, in a long time in this time series, it's because the demand surpassed the available space. But we also faced a big increase in construction costs. We faced a big increase in financing costs, here depicted with the Euribor. So this is also parts of the dynamic behind the development. And of course, we and many other market participants really introduced ESG aspects into the buildings we are building and developing. And this, of course, is part of the reaction when it comes to pricing and therefore rental level as well. So what's new for the yields when we look at the last years? This is slightly different because we immediately saw a reaction when the EZB changed the interest rates on the 22nd of July in 2022. So it's really before that day and after that day. And you can really see this in the trough, for example. If you look back, it took more or less 6 quarters to have a compression of 85 bips in the top secondary markets, and for the top markets, 75, along with the logistics region in general. And then from the trough to the next peak, when it comes to the decompression, it only took 5 quarters to have an increase in 105 bips or even 130 bips. And as you can see, this was the peak we faced in the last half year of 2024. By the end of 2024, we saw a really slight decrease, but it's seeable. We see it when it comes to the investment volume as well. So this is really changing the turning point into a new beginning investment cycle. Where is the change where can you see the changes? It's more or less in the Eastern European markets, where we have really high yielding countries still in the market. For example, CEE, but Romania as well. There we are really coming from a very high yielding situation. So starting in compression is not so much changing for the investors when it comes to pricing. So this was for them manageable. And there's the demand picking up again after a few quarters of decrease because of the geopolitical tensions in those areas. On the other hand, we see still some markets in Germany as well, but also in the Benelux, especially in the Netherlands, or when it comes to Spain. But here we'll get the details from Sven on this one. What are the drivers behind this? Of course, like I said, it's the interest rate and the fund rate when it comes to the yield spread, which is a really important aspect for investors when they pick assets to invest in. This was really changing from record-breaking lows to levels where they have to adjust to. It was nothing they can do in a few quarters. It took some time. And this changed during the last quarters, as we can see, for example, in the INREF investor sentiment. We saw many quarters below or with a negative sentiment on investment behavior. And this changed during 2024 and increased quarter by quarter, steady but slow. And even despite the economic situation, the indicators changed to a low. So the consensus is investment is again gaining some moment by the sentiment of investors. Okay, I'm clicking, and as we can see, in the same period, the dry powder of the investors were really piled up. They wanted to invest, but they waited and see if the price level is going down. So they really could hit the market with their dry powder when the moment was really right. And they saw in the last quarter or half year that the price level is not changing dramatically. So they really started to invest again, as you can see here on this diagram. Where are we now? As you can see here in the top market, the top cluster, it's the biggest or the highest primary rent levels is more or less focused in the Netherlands, Germany, Ireland. This is very dynamic of their own. High price level, high cost of living, and some other drivers behind it. And of course, in those high rental markets in the UK in general. But as you can see in the top of the cluster, you can see some Swiss markets, for example. Those are the markets with foreign currencies and high cost of living, which then reflects back to, for example, higher price indicators in many of the important systems when investing and developing logistics real estate. When it comes to yields, the picture is slightly different. You have a very mixed picture, but still many in the Dutch market part of the play, even in the top cluster, many different German markets, and of course some UK markets as well, but not so many other countries in this regard. So this is the mixed picture for the markets in general. We always want to know what is happening in the future. Therefore, we introduced the forecast together with Oxford Economics, but we also want to know what does the crowd intelligence sees when they look into the market. When it comes to rent levels, they see since a few quarters a rather stable outcome, but it's interesting to see that they see this divergence, what I said earlier, is really increasing, and a little bit that they see that markets are there with the possibility of increase in rental levels. This is a framework condition for the whole industry, what I talked about a few slides ago. And as you can see, it's nothing too much on the bright side with favorable situations. So we're facing some issues in the markets as well. General sentiment for the economic side, demand is slowing down, but even new supply pipeline slowing down. So a new peak cycle could start in the next years. This is one of the drivers we identify for increasing rent levels later on. Vacancies, nothing too much to worry about, but it's increasing in many markets, and of course still very high construction costs or financing costs. When we look into the future, despite those current situation, we see this is gaining a more favorable situation. So we see possibilities of a rental increase above the inflation rate in the next 5 years. And this is true for almost all of the markets we are monitoring. And this is not in BIPs, but in compound annual growth rate. We see the biggest chunk in the markets for the next 5 years still within the possibility of increased rent levels in the depicted amounts. When it comes to yields, it's basically the same questions, but with the question, how does the yields develop in terms of decrease or increase? And we see not so clear then when referring to rental levels, but an increase in contrary positions. Biggest chunk, but somewhat decreasing for the constant side, and an increasing level for a decrease, in this case, beginning compression. So really what we see in the figures as well, slightly, but then increasing compression. And when it comes to the framework condition for investment markets, it's a little bit more on the bright side, since inflation is really going into the right direction, which makes it possible for the monetary policy to continue on the decreasing. A few days ago, the ECB decreased interest rates. This will, for 2025, be the case, so that we hit a 2% a base level by the end of the year, and then staying constant. That's a current forecast situation. So it really improves the liquidity situation. On the other hand, exit yield expectation and capital flows and new investors are still somewhat distorted. So we see this will be increasing, but it's not too much on the bright side at the moment. But still, we see a decrease in the yield levels for all of the markets, but not being able to hit the levels we saw during the trough of the market in the best situation we saw by the end of 2021 or the beginning of 2022. So it will slowly and steadily continue to compress, but at the end of the forecast, then will not hit the best market situation of the last cycle. Again, here is a situation where we hit or enter the market by the end of the forecast period. But let's skip to the conclusion. What I said in the beginning, what does this mean for the market? We see that the established markets are, again, best positioned to capture the growth in near term. If we see, for example, the take-up, it's more or less concentrated as a well-known and most favorite market. This is in contrast to the market situation we saw earlier, when the availability of plots and workforce were really scattered across the different countries. So the investment and development activity was very broad. This is changing again. Then we see the initial signs of the yield compression. So the cycle of the decompression has ended, and we are very confident that the direction of the future pricing has increased with beginning yield compression, very slow, but then steadily increasing. Like I said, the market is diverging again, so it is really important to have local teams and sector specialists. So if someone looks for an investment, better go to a party where they are local experts, which really knows the people on the ground and the markets, and of course look for someone who's really experienced in the asset class. Like I said, we have now we lost. Now we're back again. The economic recovery will bolster the sentiment, and then we have a slightly a good moderate rent outlook for the next phase, and starting of an opportunity of good investment possibilities in the near terms. And then, of course, focused on prime location, strong tenants, and ESG covenants. So I think this all the dry powder I had in store. Now back to Richard and to Sven.
Great, thanks very much, Tobias. Really interesting. I think lots of things we can drill down to. There's already some questions coming into the chat, but please do add those. I think some of those graphs really interesting to see, particularly in terms of how markets are beginning to see themselves, what's happening with yield compression, and also very interesting to see that dry powder that had been built up beginning to come into the market. So Sven, over to you now to drill down into the Spanish market, which of course has seen quite a positive view generally. I mean, certainly, you know, one of the interesting things that I've found is, having been speaking to the various markets about the outlook across Europe in general, in Iberia, Spain in particular, there's been quite a positive view. So very interesting to see what you're seeing there in the logistics market, Sven.
Yeah, definitely. Thank you very much, Richard. We are definitely not at the end of the road this time in Spain. So we have a very stable economic situation. As you know, we had economic growth last year about 3.2%. We're expecting economic growth about 2.5% this year. Maybe we can put on the slides a little bit, which is not working, I guess.
Matthias, that's better.
Yeah,
let's put the,
great.
let's put
Thank you very much.
Super.
As I said, we have a very stable economic situation. Spain has a very, very good infrastructure. And also we have one of the most biggest and important metropolitan areas in Europe with Madrid and Barcelona. And this shows also the logistic market, which is quite concentrated on those both cities, as the take up for Madrid and Barcelona in total is 72%. So we have still only 28% left for the secondary market of Valencia and Zaragoza, and a little bit for Bilbao, Malaga, and Sevilla. So this shows also why we here in GARBE are concentrating in the last 2 years and then the next 2 years completely on Madrid and Barcelona, as these are the main markets in Spain. As I said, we have a very stable economic situation in Spain. This is also driven by the very positive key figures, a part of the GDP growth and the inflation rate, which is completely under control in Spain, which is about 2%. We have a population which is growing in Spain since over 10 years, and the forecast for the next years, what you can see here, is in 2030 up to nearly 50 million people living in Spain. We have a decreasing unemployment rate, even if you think it's still very high, but there we have to say unemployment rate figures in Spain, you always have to double check. I would say so. The real one would be quite lower than the official one. And we have a private consumer spending, which is increasing also in the next years, which obviously makes it clear that the logistic market will be performing quite well, especially, as I said, in the 2 biggest markets in Madrid and Barcelona. So, but we have to have a deeper and more detailed look at those 2 biggest markets in Spain. So Madrid is the biggest market, the biggest logistic market in Spain, but Barcelona far is the best. It's the strongest one. So even if we have a take up in Madrid about more than 1 million square meters a year, which was 3rd highest record in the last 20 years in Spain, and we have in Barcelona, or in the Barcelona region, I always talk about the regions if I talk about Madrid and Barcelona, we have a take up about 700,000. The vacancy rate in Madrid is quite high. We do have a vacancy rate about 10% facing this in 2024. And in Barcelona, in the region of Barcelona, we have only 4.8. But even this shows not, let's say, the real market, as we do have clusters in Madrid, for example, in the south at the A42, where we have in Yescas, one of the biggest clusters in Spain, where we have over 200,000 square meters speculative constructed area completely empty. And if you go then to Barcelona, we have more or less 60,000 square meters of new build speculative logistics empty, and coming new to the market, nearly 0 in Barcelona. So what means the 4.8% of vacancy rate in the Barcelona metropolitan region, it's not just only 50% of the one in Madrid. It's just facing that's only 60,000 square meter of new constructed area is empty, which shows directly also the market dynamic in rents and also in yields, but more in rents. As we can see, the prime rents in Barcelona are nearly 50% higher than in Madrid. So if you compare, for example, what I said before, locations like Yescas, which are 35 kilometers far away from Madrid city center, to ones in Barcelona, which are also 35% far away. We are comparing here rents about €4 and €4.10 in the south of Madrid to €6.57 in Barcelona, with the same distance to the city center. So what make it clear that Barcelona is much stronger than Madrid. And even again, Madrid has the highest take up in all over Spain. This means that we are obviously you have to be more careful in Madrid with new developments than in Barcelona, especially if you see that in Barcelona in this year, 2025, we do not know even one new development coming to the market in the metropolitan area of Barcelona. And obviously, we still have some 100,000 square meters empty area in Madrid. So, which makes it clear that the Barcelona market is the strongest one. And the reason of this is obviously the geographical location of Barcelona. We all know it's the biggest city in the Mediterranean area. So you have the sea on one hand, you have the mountains on the other hand, you have a very high local demand, you have a demand from one of the biggest harbors in Europe, and obviously also the demand from France, from the border from France, which make it so attractive for the hopefully also for the investment market, where you can see also differences between Madrid and Barcelona, but not as high as the rents. So we see here that prime yields are going down, not as fast as rents are going up like in Barcelona. You see here the last quarter of 24, which Barcelona shows 5.10 and Madrid was 5.2 as the prime yield. But you know, Tobias, I told you this at the end of last year. Let's say 3 deals which are in the market now, we are seeing that they are going below 5%. So we guess that we will see in Barcelona 4.8, and we will see in Madrid 4.95, 5.1. So this is a spread between the prime yields in Madrid and Barcelona. Obviously, based on completely different rents, what I said before. So if you take the one 4.85, 5.9% in Barcelona on a rent of 650, obviously capital value is completely different than the one in Madrid. Yeah, coming again to the key factors. I'm moving on fast as we do not have too much time today. The big difference between the main markets in Barcelona and Madrid is a part of the vacancy rate is that there is no land available in Barcelona. So if you want to develop something in Barcelona, you do have to develop your own land, or you do have to do brownfield developments, which are also not easy to find in Barcelona. As you know, if Barcelona is still one of the industrial hotspots in Spain. In Madrid, I would say brownfield is easier to find and to get. And land development is taking as long as in Barcelona. Maybe it seems that there's more land available now in Madrid, but I guess from our point of view, this will change at the end of this year. And then new land development, as you know, takes a lot of time in Spain, like in other countries, at least I would say between 5 and 10 years. So what is not in the market today will be not in the market in the next year regarding new land developments. We have to. Yeah, sorry. First, it does not work. Now it works too fast. Coming into the investors market. So the Spanish logistics market, as we said before, it's quite well performing. And this shows also that new players are coming to the existing one that's in the investment market. The existing one, the most active in the last year was definitely Exeter. And also we had players like CBIE Invest, Hansa Invest, Amazon, which bought their own fulfillment center in Girona, Heinz, Azora, and Savills. And new players, what you have seen here is generally Fidelity and Mapletree. So on the exit side, if you have a very good product, we would say there's no reduced risk that you can see your expected returns and your expected yields, as there is more demand than, let's say, core product in the market. So the investor side, it's quite positive, also in the all over European environment. and tip again, and we'll pass 2 pages now. Yeah. And what does it mean for GARBE? What have we done with all this information and market objectives of what we do know? What we've done in the last 24 months is a greenfield and brownfield development. So we are currently developing more than 250,000 square meters in the south of Madrid. Even if I said there is, let's say, high offer on existing warehouse, there is no land available. So for us, it was a clear decision to step into land development, from zero, starting with the urbanization process until the land is developed, which brings us in the position, obviously, that our land price and land value is down below than the other developers, even if we are in the same area. Another greenfield development we are doing in the metropolitan area of Barcelona, 35 kilometers from city center, another 19,000 square meters. Obviously, as I said before, there's no land available in Barcelona, so we are, I guess, the only land developer in Catalonia or in the metropolitan area of Barcelona. And then we made 2 brownfield acquisitions here in Spain, one in the first ring and one in the second ring. The second ring is the last one, what we acquired in end of December last year. So at the A2, the most important highway between Madrid and Barcelona, entirely 30 kilometers from Madrid in Alcalá de Henares, where we bought some existing very old stuff, what we pulled down, and now we are going to develop there a new warehouse in the next few months. And obviously, what's interesting to see that this was an on-market deal at the end, and we bought it just 6 weeks ago, and now we are facing the situation that we have the first tenants interested in the site. So as it's seen, so obviously Madrid is not as strong or as easy as Barcelona, but also if you take the right decision and if you buy the correct location, then it's also a very well performing market. Thank you, Richard.
Perfect. That is the chance for me to step in, Sven, I think.
Yeah.
Really interesting to get that dive down into the Spanish market. We've got questions coming in, and I'll pick up on one of those. It'd be interesting to get your view on it. So this is a kind of what's driving the rather positive rent and yield forecasts. Looking at existing fundamentals and investor confidence polls, this leads to a more pessimistic scenario, in my opinion, is a question. So that's an opinion coming through. So it'd be interesting, I guess, to get the view why you're seeing that as more positive rent and yield forecasting. What's driving that from your perspective, if you want to pick that up?
So on mute. Yes, of course, I can pick up on that, and maybe Sven can add from the Spanish point of view. Of course, we're aware of the situation, especially in some markets like Germany, where the economic situation is not really looking too bright at the moment. But in the forecast, we are based on a really local level, a municipal level approach. So we see at the local market dynamics together with the macroeconomic drivers. Of course, we see the industrial sentiment at the moment is not too good, but on the other hand, e-commerce, which provided really a boom during the pandemic and then really hit a slowdown because it piled up too much, for example, space, which the consumer climate did not meet then. But if you make see it on a long time series, you can see it's just the pace we had really for the last few years. compressed to a short amount of time. This is now coming to a normalization. And for example, I was on a conference on the future commerce a few days ago, where many of the e-commerce providers or the logistics providers were part of the situation. And they say, and we see it in our company as well, that e-commerce, for example, is picking up pace again. This is especially true for e-food, for example, and for example, everything's can be compared to quick commerce, like a social commerce. Everything is a Temu or Shein doing. For example, big players like Amazon are adopting. So from this point of view, there's a demand increase, for example, because the Chinese player don't have any footprint when it comes to warehouses. So they really have to build this up. This is also true for example, Chinese car producers, which don't have any service network in Europe in place. So there's a new part of demand coming up. Then again, you have the still ongoing discussion about re- and nearshoring. This for sure has been dampened by, on the one hand, the cost cutter coming back into place after the pandemic years, saying, oh, this is not really a good thing in terms of pricing, because producing in Asia, for example, it's cheaper. But then there's still some players who really had to face the situation that they say, okay, we need to be more close to the consumer or to the producing side. So having a real big hub in Europe is one goal for them. But increasing satellite hubs, for example, if you have your big hub on the Benelux, then you tend to build up a next smaller hub, but still a hub, for example, for Southern Europe, either in Italy, for example, or in Spain, or similar approaches. And then again, we think, and those are the projections of the big macroeconomic forecasters, that the economic development will increase during the span of the forecast. Is not only 1 year we are forecasting, but a 5-year forecast span. And since we are living in a poly crisis since a few years now, we have to adopt to situation where one industry is taking a slow down, whereas other industry are working out quite good. For example, pharma industry in Europe and Germany is faring quite good at the moment, which weren't this good in situation a few quarters or even years ago. But on the other hand, machine producing is difficult. So yes, a slight rental increase for the next years is possible based on those drivers.
Great, thanks very much, Tobias. Sven, it'd be good to get your view on that, and then I've also got some questions in the chat coming, and I'll pick those up as well. But it'd be good to get your take on it, because there's definitely a more positive view in general coming from Spain, certainly from my visits there.
Yeah, very brief. So obviously Spain we have a very good infrastructure. We have the highest increasing numbers of passenger and logistics on the airport in Madrid and in Barcelona. We have the biggest port expansion project in Valencia in Europe. And obviously, on top of this, we have a logistic park which is not so developed like in other countries, especially like in Germany. So there is a lot of way to run for us. And if you see the rents, especially what Tobias showed today in the pyramid slides, Madrid is not even on the list of the highest or best 25th and 30s, and Barcelona is one of the last. So what does it mean? If you see that you pay €4 right next to the third biggest metropolitan area in Europe, so after London, Paris comes Madrid, and the same you will pay in the same location right next to Paris, London, or even Berlin, 100% more. Then I guess it's clear where we can see the rental growth and the demand is coming in for the growth for the next years in the logistics sector in Spain.
No, I think that's a really interesting point. And Tobias, question also coming in on the main cause for yield compression in Western Europe. And I'd also like to pick up a little bit on Eastern Europe as well, because you were seeing quite a lot of potential for growth in that area.
I'll start with Eastern Europe. On the one hand, of course, you see the way up higher yield levels than you see in the established market. Of course, there's much movement to be expected here. For example, if you look 10 years ago in the Western parts as well, the rental or the yield level, was way higher than we're seeing now, because back then, logistics was a niche market, not very well established. This has had to change. On the other hand, CEE is a new market which is establishing itself when it comes to footprint. There's a lot a way to go. Also said for the Spanish market, this changes a lot. There's much to be built up there, much demand, for example, and therefore a high pressure on the investment market as well, because it's so new. When it comes to an established market, it's like I said, the demand is still present. We had a few years, many years in the past cycle where the demand was not being able to meet or the supply was not being able to meet the demand, so a demand surplus. This is at the moment dampened, but the investors really sees it's really intriguing from them to invest in logistics and industrial assets. So there's a huge interest there as well. What we can see with our joint venture partners, they are looking especially for industrial logistics, for residential, for data centers. But this is the core interest, because it's a huge market for logistics, is for the trade, and therefore it's still interesting for investors. Therefore, we see the beginning yield compression cycle.
Okay, good. Sven, a couple of things coming in for you as well. In terms of the views on the Spanish market, do you also have a view on the comparison, I suppose, with the other Iberian neighbour there, Portugal? I suppose that's the question. How do you see those two markets? And also another one, which was the view that the Spanish market is traditionally an owner market, and does that have implications in terms of the investment market more broadly, I suppose, Sven? So I don't know if you want to pick up either of those.
Yeah, for sure. So Portugal obviously is also a very well-performing market in the last years, but on the other hand, it's smaller than the entire Portuguese market, smaller than the Madrid market. So this for us was a reason to concentrate at first on Madrid and Barcelona, and not going directly, let's say, abroad to Portugal. But again, it is a very well-performing market. It's also very concentrated on Lisboa and Porto. So and sometimes we have to say we see higher rents, for example, than in Madrid, not in Barcelona, but then in Madrid. And so this is clear because there was also a long time no development going on. There is a higher demand than offer in the market. So let's say a quite good situation for a developer and investor, but not easy to find investment grade product in the market, as again, there is a higher demand and not so much development going on.
Yeah, interesting. And in terms of that view about the Spanish market and whether there's more of an owner-occupier side there, does that make I suppose the market a little more granular, a little more difficult to access? What's your view?
Very good question. Let's say the land acquisition market in Spain is not very professional, so it's not driven like if you compare it especially with Germany and the UK, which is a very professional market. The landowners are obviously often private individuals, which are not so professional and connected in the market. So this is completely different. So on the other hand, yes, it is also an operator owner market. So what we see in our developments, our land developments, for example, that we have we even not have started the urbanization works, but we see now operators coming to us and asking us if we can sell the land, if we can do a forward purchase or forward funding, BTS development. So yes, you're right. It is still very, or maybe in the current situation, very operator driven, where the demand is coming from. Yes.
Interesting to hear that. A question's come in as well, which I guess is a question that is appearing a lot in general, which is, I didn't hear anything so far about the approach of the US. How do you see the discussions of Trump affecting the market? And interesting, of course, because it's actually quite difficult to judge because things are changing moment by moment often. But I suppose just in general, Tobias, I guess, how do you see, do you see there being a difference in trade across the year? I suppose, are there key things that from a GARBE position you're looking at in terms of the influence on real estate and demand, or do you see this as more of a kind of political risk element that is less directly influenced, I suppose, to the real estate side?
Well, a trade war, which might be on the brink, is not really useful for anyone who's participating in the system, not for the US side either. So everyone knows this. This could backfire to the US as well. And there are many calculations from economic forecasting companies really are digging through the, like you said, momentarily changing announcement to 10% tariffs, 20%, or so then there's nothing, it's postponed for 30 days like we saw yesterday. So this is not really a good foundation to calculate a forecast on. So there are, of course, scenarios. And if you have a full-fledged Trump tariff scenario, of course, this will impact the European and the German economic, by big. It's huge impacting, but the US as well. So. In our estimation, or like we follow the approach of the big forecasting companies here, we have to prepare for it, like the European Union does with counter tariffs, but no one really wants it. But does it have an implication by 1% of the BIP, by 2% of the BIP? Nobody can really assess it. In the main scenarios, I saw 0.6%, for example, of the German economy. Of course, this is a real slowdown together with the weakness we see at the moment. And like I guess most of the viewers will know that Germany is electing by the end of February. So this will have an impact as well. So what kind of economic policy, industrial policy we're following for the next years. Since we are facing the poly crisis at the moment, we are focusing on the moment, and we see that the framework condition based on the very instant are clearing up when it comes to interest rates and financing situation. We see that some demand is coming from certain tenant groups, whereas others are weakening. So at the moment, we still, and this is the case why we follow the yield compression and the slight rental increase approach in our forecast is playing out. But everyone knows it could be different in a few months when the real trade war is starting to show its face.
Yeah, one of the difficult things, I think, really to be able to judge and factor in for this kind of research for certain. Sven, interesting that you mentioned as well the fresh capital coming into the market. Are you also seeing fresh operators coming in? Because traditionally less e-commerce, obviously, in Spain than in some of the other countries. Are you seeing growth there? What are some of the trends that are driving the market, I suppose?
Yeah, on the, let's say, tenant operator side, we do have the 3PLs and the supermarket companies, but it's not e-commerce, to make it clear. So e-commerce was driven by Amazon, which they are not definitely now on the demand side. So they are more getting into competition because they are leasing out some space, what they own and what they occupied or what they do not need anymore. And so we have the classical 3PL, the classical logistic and the supermarket, and also obviously fashion and retailers in Spain. There are coming new players to the market, like Action Supermarkets were coming 1.5 years ago. And we see a lot of movement in the, let's say, Chinese sector. Like Tobias said, as Madrid is one or maybe the biggest Chinese hub in Europe. And so there's a lot of demand coming from. So it's moving. But on the other hand, what you said, operators driven, owners market, what we see still also regarding our developments.
Great. Very specific one, which I think probably is for you, Tobias, which is what is the key metric to track regarding rent and yield development for 2025? So that's obviously somebody wanting to have you as their researcher.
Yeah, this is an interesting research question, because, like I said, there are certain indicators, the framework condition, like construction costs, like financing costs, like ESG. So how we build our buildings is completely, or has completely changed in the last few years. From we are building right now a wooden distribution center. Of course, we have heating pumps installed almost in every new developments where heating is necessary. So this is reflected in rental levels as well. But then, of course, it's basically supply and demand. We had many years where, like I said, the demand level was higher than the supply, thus increasing rental levels. And this was also true in many quarters for existing stock, even older stock. During the aftermath of the pandemic, we really saw everything was let, basically, not even the oldest shed. This changed, of course, and now we have some markets where we have too much space in the markets, but this could be only for a brief moment, because even when distribution center can be built faster than other asset classes, it takes some time, and of course people get cautious, so the pipeline is slowing down. And it's a typical thing with real estate. If the take up is really showing signs of an increase, then the supply side cannot react on the instant, and then with the typical peak cycle. So this could be true for some of the markets. And like I said, some of the markets really at the moment face a situation that they really have to let off first before entering the next development phase. But these are the major drivers behind rental increases.
No, that's interesting. A couple of quick final ones for me, because we're getting closer to the time. But Sven, and I'll be interested to get your view on this, Tobias, as well, is what are the occupiers looking for? We mentioned, obviously, top-rated ESG, those kind of things. Is that the same in Spain as it is elsewhere? What are the occupiers looking for when you're developing something for them?
Yeah, the clear answer is yes. They're looking exactly for the same, maybe with some minor differences. Obviously, heating is not so important in Spain normally. So, but a part of this, I would say, the quality and it's more or less the same like in all the other European countries, and ESG is a must. So and nobody discuss it anymore. So more or less the same, as I said, same quality, same state of the art.
Okay, good. There's a couple more questions coming in, so I'll just try and pick these final ones up as well in the last couple of minutes. Do you think the current yield and rental situation and how it develops provides a good opportunity for investors and developers to expand into the new markets? Interesting one there. And the second one is, what are the average long leases terms for countries and tenant types? Quite a lot to try and fit into 2 minutes, but let's do our best with those. So maybe, Tobias, if it'd be interesting to pick up on the long leases term. How are you seeing that between the different countries, different cities?
Oh, I would have proposed to answer this one by Sven, to focus on the other one.
Fine, then focus on the other one.
Because Sven is the one leasing out.
That's good. Then you deal with the first one, Tobias.
Obviously, speaking about Spain, so if we do a BTS development, obviously we're talking about long leases, at least 10 years, German standard leases, I would say. If we do spec developments, it depends always on everything. No, like Tobias said, it depends on the location at first. So if you have a perfect or a prime location, obviously you can ask for a longer lease and higher rents, like always. And if you do a spec developments where you're facing a lot of competition, you're in a completely different situation. Where you have to accept, I would say, still short leases between 3 and 4 years. So this is the range where we're on to, between 3 but up to 15 years. Fixed lease, so but depends obviously on location and if it's a BTS, BTR, BT speculative development. Yeah, so I know it's not it's a very wide range what I'm telling you, but this is really the fact.
No, interesting. Good. You know, it's great to get that real perspective, I think. And Tobias, I guess on your side, let's also then pick up that point, which is just about yield and rental situations. And do you think that provides a good opportunity for investors and developers to expand into some of these markets?
We think the southern parts of Europe and the eastern parts of Europe are really interesting to enter. So the big opportunities to go to the markets, because the footprint is compared to more saturated markets rather low. So there's much room for improvement to increase the logistics stock. On the other hand, for example, if you continue this reshoring or nearshoring, it's more or less nearshoring a discussion. You say industry is going there where the labor market is available. You have a workforce available, you have cheap labor available, cheaper costs of plots, of energy. So this is all concentrated in the Eastern European market. So again, a big plus for those markets as well, and for the southern markets, of course, also true. And of course, if you see what is changing on a global scale, supply change, or even infrastructure changing, the route between, for example, Poland going southeast in the direction of Turkey is a real interesting axis for future transportation. So hubs alongside these axes are really gaining importance in the future. So being there in the markets, especially being one of the first movers, it could prove very interesting to investors.
I think that focus there on different and new opportunities is really interesting. We're sadly out of time. Thanks very much, Tobias and Sven. Really interesting presentations. Everybody can download those presentations shortly off the Real Asset Media site. So that's realassetmedia.com, and we'll send everybody a link to that as well as soon as that's published. Thanks very much for your questions and for watching. Great to have so many questions and interesting that we could share those with everybody. If you've been watching this on demand, thanks very much for watching, and look forward to seeing you at the next one. Thanks very much, everybody. Thank you.
Thank you.
Thanks, Richard.